Our SDG Credit Income strategy is a multi-asset credit strategy with the aim to optimize yield and generate attractive income through the cycle. It's an unconstrained approach as we can invest across different asset classes like investment grades, high yields, emerging credits and subordinated debt of corporates and financials. The strategy has a lot of flexibility to optimize its income and return potential while minimizing downside risk in adverse market environments. Based on our top-down views, we determine the tactical asset allocation, and we can quickly adjust it in response to changing market conditions. For example, if one segment suddenly becomes more attractive, we will exploit these opportunities. In terms of credit quality, we focus on the BBB, BB space, as this is the sweet spot in credit markets from a risk-return perspective. And we also focus on shorter dated credits with a maturity or call date up to 7 years, which also is the sweet spot from a risk-return perspective. And there's another unique feature of this strategy. It's called SDG Credit Income, as we've applied our proprietary SDG framework to screen out companies that are negatively aligned with the 17 UN SDGs. And as a result, the portfolio makes a positive contribution to the SDGs, while a stronger sustainability profile also helps to reduce downside risk. So this strategy enables investors to benefit from attractive yield and income while making a positive impact to planet and society. In terms of portfolio positioning, driven by relative valuations, we prefer investment grades over high yield and developed markets over emerging markets. In line with our outlook, we currently have a significant exposure to European financials. The portfolio's duration is 5 years, which is at the high end of the range as a hedge against credit market volatility. The portfolio's yield is around 6.3%, while the average credit quality is BBB/BBB-. So I would say that's quite compelling from a risk-reward perspective. We have a very constructive view on European financials for several reasons. Firstly, European financials have very strong fundamentals. In particular, capital buffers, asset quality, funding diversification and liquidity profiles have all improved significantly over the past decade. Secondly, banks, and to a smaller extent also insurance companies, clearly benefit from the higher interest rate environment, as it improves their profitability. And lastly, valuations from a credit spread perspective are more attractive for financials than non-financials. Our financial institution bond strategy invests in subordinated debt issued by banks and insurance companies. And we do this via a quality approach, as we focus on Tier 2 debt, while the exposure to the more risky CoCos is actually kept at 20%. In contrast to some of our peers, we invest in banks and insurance companies. And we like this combination as insurance companies behave differently through the cycle than banks. So this provides interesting investment opportunities, and it also provides diversification benefits to the portfolio. We believe this fund has a very compelling risk-reward profile. And to illustrate that, the fund's current yield is around 7%, which is quite comparable to a global high-yield index, while the average credit quality is investment grade, which is quite comparable to a global investment grade credit index. So 7% yield at investment grade risk, I would say that's very compelling. In terms of portfolio positioning, we currently have an overweight beta positioning of around 1.2, given our constructive view on European financials. And from a sector perspective, approximately 35% of the portfolio has been invested in subordinated insurance debt, close to 60% in subordinated bank debt, and the remainder is held in cash. And our off-benchmark exposure to AT1 and RT1 CoCos currently amounts to approximately 15%. Then lastly, on performance, the team has built a very strong track record since inception of the strategy in 2011. We've outperformed the index by more than 120 basis points on an annualized basis since inception. Well, obviously, this year has been quite challenging for fixed income markets in general and for the financial sector in particular, given the banking turmoil in March. Nevertheless, total returns are in positive territory, and we've even managed to outperform the index by close to 40 basis points over the year to date. And that is mainly thanks to successfully managing the portfolio's beta throughout the year. Last, but definitely not least, for both strategies we offer distributing share classes, and the current payout ratio for both SDG Credit Income and Financial Institution Bonds are 4.5%.